Rental properties, once sort of seen as the bastion and cornerstone of any investment portfolio that clients would hold, have come under a number of sort of scrutinies and different measures that have been considered. We're all aware of the Bright Line test, have been extended from 5 to 10 years, but one of the more interesting proposals is around the interest deductibility. Many years of case law around the ability to deduct costs associated to generating income are thrown out with one foul proposed swoop by the government. But how does it actually work? Well, for starters, they're a proposal and a consultation, but let's just assume it's going to pass into legislation. Interest on the investment into rental properties is going to be limited on all property after the 29th of March. The date that the legislation was first proposed. Let's say you have a $200,000 mortgage. So the year ended 31 March 2022, the current year we're in, you'll be allowed to claim 100% of the interest deductibility to the October, or the 30th of September technically, and 75% of the interest to March 2022. Now what does that mean in numbers? Let's say on $200,000 mortgage that your interest is at say 5%, which is $10,000. For simplicity purposes, $5,000 is going to be 100% deductible against your rental income, and then it's going to reduce down to $4,000 in the 6 months for the next part of the financial year. That then carries on at a reducing rate of 75, 50, 25% until eventually it'll become 0% deductibility. But what impact does that actually have? So if we continue on the theme of $10,000 being our interest deductibility, this will now in effect no longer be deducted on the sliding scale rule. If we assume rents remain the same, say $20,000 of rental income, and in the past you had $5,000 worth of costs, recognising your rates, insurance, other sort of incidental costs, repairs and maintenance, you would then have $15,000 profit. With interest deductibility of 10, you would have paid tax on 5. Without that interest deductibility, you're going to be paying tax on $15,000. Now, of course, the problem is let's say, for example, you're currently paying $1,000 a month off your mortgage, recognising interest and principal. On this basis, you would have had, with $10,000 deductibility, $5,000 profit you'd pay tax on. But from a cash flow perspective, you would have paid out another $12,000, would pay $12,000 out, being the $10,000 interest and $2,000 principal. So you'd only pay, while you'd pay tax on the 5, you would have had spare cash to pay. Come to $15,000, you'd actually have negative cash to pay because you're paying tax on 15, but you're also paying out $12,000 to the bank and mortgage repayments. So what does this mean in a practical sense? Under these proposals, property is now going to be part of an investment that doesn't have as much of the tax benefits as it originally did. This doesn't take away from the fact that people will still look at buying property, but most people will now be looking at it as an alternative form of an investment to, say, for example, bank deposits, as opposed to sticking it as part of your overall portfolio. So the question is now to ask, when you're looking at investment property, how does this fit? And proper advice should be given on the cash flow and tax implications before you purchase a property. Moving forward, from the 29th of March, there is proposed to be no interest deductibility rules.